My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. To my friends, I'm just trying to make you a little money. My job, not just to entertain, but to explain. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. They're back. That's right. Mag 7, bang, whatever you want to call it. And these big tech plays are demonstrating their staying power no matter what happens. They've got that kind of poltergeist 2 magic. This is the first of the 4 main weeks of earnings season. And these quarterly reports matter a great deal to you, to the stock market, to our portfolios. We know this moment is fraught with concern, especially after the market's remarkable run. You can see the tension when you add the average. They just kind of look like they're going to roll over. They snap back, they're going to roll over. But Dow ultimately finished up 201 points today. S&P gained 0.77%, and the Nasdaq jumped 0.87%. Nice move there. After all this sturm and drang over earnings, you might be wondering how the heck is it possible that the Magnificent Seven can somehow reassert their hold over the market? How can they keep coming back over and over and over again? So, at the risk of them suddenly rolling over tomorrow morning, making me look, ill-advised, I want to explain what's going on here as we begin the 3rd year of the current bull market. Of course, we're talking about Alphabet, Amazon, Apple, Meta, Microsoft, Netflix, NVIDIA, and Tesla. I know Netflix doesn't belong in the Mag 7, but it was part of the original FANG that I traced out. And besides, I'm pretty sure I created that acronym on partial Netflix. Plus, it reports on Thursday, and that's so it's front and center. That said, I don't want to minimize all the other groups that are rallying. Not when Wells Fargo, which we own for the Chapel Trust, reported a terrific quarter on Friday and is still going higher. Unlike previous Mag 7 rallies, this one's definitely not a zero-sum equation where the rest of the market does nothing. Other groups can work, too, in this market, perhaps because there's just a lot of money going around. And we know that there's a lot of money coming into the market because the Fed's cutting rates and friendly cash isn't going to be worth as much as it was. But the staying power of the Magnificent Seven, I just call that truly unbelievable. Hey, why don't we start with the 2 stocks on my own them, don't trade them list. That's Apple and NVIDIA. Today, 2 firms, JP Morgan and Evercore, talked about why you need to buy Apple. Both pieces stressed that maybe people have gotten too bearish on the stock ahead of the earnings, so we might need to rethink all that negativity and just buy the darn thing. I mean, it's bizarre that so many people are so eager to hate the stock of one of the greatest companies in history, especially when the stock's been such a great long-term performer. Quizzical, isn't it? Yet this happens whenever they launch a new phone. It feels like almost every day we come in and some analyst lowers their estimates because of tracker work that showed iPhone 16 lead times were short and there's not much demand, right? I mean, blah, blah, blah. So many analysts have now shaded down their estimates for Apple that, get this, if business is simply okay, the estimates will prove to be too low. So these 2 bold analysts, JP Morgan and Evercore, would to take the other side of the trade, the positive side. Plus, many of the objections to Apple may not hold as much water as they did even a couple of weeks ago. For example, we know a lot of people were worried about Chinese demand, but get this, if the Chinese government's actually able to stimulate, right, the stimulus plan to start working, well, don't you think that China's issues are smaller concern? More money for consumers in China means more orders for the prestigious iPhone. This is why I always say own it, don't trade it. The analysts always try to scare you out of Apple based on incomplete data. And from a long-term perspective, think about it. They're always wrong. If you'll sit Apple in the most recent bout of negativity, you missed a tremendous run over the past week. And then you did it before that. You missed another run, then another and another one. No wonder they call this stock the Teflon Don, or at least Ben Reichus over at Melius, a big Apple supporter, calls it that, and I like it. Or how about NVIDIA? All right, NVIDIA, what can I say? By the jocular admission of CEO Jensen Huang, this company had its biggest miss ever in the last quarterly report. Now, initially, NVIDIA got clubbed along with the whole market when the yen carry trade imploded. Then it came right back because that was only a temporary problem. Then NVIDIA got smacked down after its quarter, although it didn't take out the blows from the previous sell-off. It's been working its way back ever since, as we learned that demand for its next-generation superchip Blackwell is, quote, insane. That's a technical term coined by Jensen, by the way. Next thing you know, the stock's coming all the way back. But back with very few people who sold the stock and before this, right? I mean, they're long gone and gone at much lower levels because they traded it. They sold it. Again, take this as a reminder that if you trade NVIDIA, you probably won't be able to sell it high and then get back in low. The ship would have left without you. It's too hard, people. It's just too hard. Now, those are the 2 I've sworn to hold, not trade. I don't feel the same way, candidly. about Alphabet. And in part, that's because the government has made it much harder to own it with this antitrust lawsuit that's aimed for a breakup, something I am very much opposed to. I'm also concerned about Alphabet's ability to keep putting up strong earnings. The company now has a less defensible position because it's become more of a media business, and that's a very competitive space. I do like that. Boy, that Sunday ticket. Wasn't that great? Do you use the 4-box? I used the 4-box, and then I hit whichever game I wanted. And I kept coming back to that Cowboy game, the Cowboy game, the Cowboy game. Anyway, I'm an Eagle fan. Anyway, so the stocks come back hit, and I am so glad we own some for the Chapel Trust. We have an investing club conference on Wednesday. Hope you'll be there. We'll talk about it. Amazon's easy. It got hammered down from 187 to 161 after that last quarter, but it's back above 187 now. I think the company simply has too many levers, including the incredible growth of Amazon Web Services, which can take it back, I think, to its $200 high. Meta's off to the races again. Why not? Thanks to the success of Reels, the targeted ads on Instagram, WhatsApp, the Meta-loaded Ray-Bans. Oh, it's awfully hard to bet against this one, isn't it? Very easy to make the case for Meta. When you exclude the cash on the balance sheet, the stock is absurdly cheap. It's kind of strange how cheap it is. Microsoft's supposed to be hurt by weakening demand for its Copilot, with its Copilot being their AI assistant. I have no idea if there's a real weakness here, but there is chatter, and that's enough to send the stock down. That said, I think the bears need a lot more than chatter to keep it down. When Netflix reports on Thursday, you have to keep in mind that they haven't even begun to monetize their new ad tier yet. I think they de-risk the quarter because management can tell a good story about the future, which is what matters. Finally, there's Tesla. I know, Tesla up 7. Disappointing self-driving car event last week. While the Robotaxi shindig was definitely short on facts, at the end of the day, do you really want to bet against Elon Musk? I don't. I think the odds are good he'll figure this out. So even if you don't want to own it, you're taking your life in your hands if you try to short it. Here's the bottom line. Even if you miss these rebounds of the Magnificent 7 plus Netflix, don't sweat the program. We know these stocks will once again be hit by endless worries, giving you more opportunities to buy among weakness before they snap right back and start climbing all over again. Let's go to Kyle, my home state, New Jersey. Kyle.
Jim, how you doing, buddy?
I'm doing well, Kyle. How about you?
I'm doing great, man. All right, I know that Uber's its daddy, but I would like to think that Lyft is at least worth double than where it's trading right now. What do you think?
I don't know, double, because the quarter wasn't that strong last time. I happen to love Dave Risher. I think he's doing a terrific job. It is a profitable company. I think that it could go to 16, 17. I don't want to say double because that's just a little too aggressive for me. But thank you for the call. Let's go to Jeff in New York. Jeff.
Hello, Mr. Cramer. This is Jeff from Sodus, New York, on the South Shore of Lake Ontario.
Wow. Holy cow. Let me get the map out. You have a map quest over there? How many, what is that? I walk there. If I walk, how quickly? Okay, go ahead. You ever hit the walk button? It's like it's always days. Yeah.
Yeah, Mr. Cramer, the air's cooler, the leaves are changing, and it's looking beautiful here in the Finger Lakes region right now.
Let's get at it. How about a field trip? What's happening? How can I help?
My kids have been back in school for over a month now, and I asked them about the shoes that they and their friends are wearing. It's always the same. Crocs. They love them. The U.S. consumer is doing well. The company has a new cheeky spokesmodel for their Hey Dudes brand. They just introduced a canine version of their shoes that are hilarious. But the stock isn't moving up. What am I missing?
You know, look, I wear my Eagles Crocs everywhere. I think the problem is this is a heavily shorted stock, 7% short position, and people are always leaning on the stock. They wear you down, and it's just what happens. I have to tell you, I think people always feel they're always one Croc away from just getting crushed, and that's the problem. If you have the fortitude, you can own it. All right. The Magnificent 7 showed their staying power today, but if you missed the moves on any of them, don't worry. You'll get another chance to buy when they get it again on the endless worries that everybody sows on Mad Tonight. Micron soared after earnings a few weeks ago, and with the stock continuing to climb higher, did investors miss the move, or is there still more room to run? I'm sitting down with the CEO. Then earnings season kicked off on Friday with the big banks, and I'm running through the reports and giving you my take on the numbers. And Adobe is hosting its Max conference, highlighting new generative AI tools in the creative space. And I'm hearing all about the latest with the company's top brass. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Exactly 5 weeks ago, after watching the semiconductor complex get hammered for most of the summer, I put my foot down, said you had to start buying some of these newly cheap chip stocks, with Micron technology being front and center. Micron is a vast chip maker that's a heavy hitter in memory and storage, including high bandwidth storage products that are essential for AI. This stock's up more than 25% in the past 5 weeks, with most of that gain coming in September 26, when Micron roared nearly 15% after reporting a strong set of results, much better than expected outlook for the current quarter. Question is, can it keep running? Well, we got to do more work. Fortunately, Micron's management was in town this week. They ring in the NASDAQ opening bell this morning, celebrate the 15th anniversary of the company's listing on the NASDAQ Stock Exchange. So let's check in with Sanjay Mehrotra, the president and CEO of Micron, to get a better sense of where the company's headed. Sanjay, welcome back to Mad Money.
Jim, great to be back on your show.
Well, we have a lot to talk about. But first, new logo, 15th anniversary, a company that, with 7 years for you, have done some remarkable things. How about the journey? Because it's an important one.
You know, journey has been fascinating, especially over the last few years. Micron has transformed itself. We have gone from a technology laggard to becoming a clear technology leader. We have multiple generations of sustained leadership in DRAM as well as NAND technology. What's even more exciting, Jim, is that we have really the most competitive product positioning ever in the history of the company, with products like high bandwidth memory, data center SSDs, products for smartphones and PCs and automotive across the various end market segments. So we are well positioned, and thanks again to 48,000 team members worldwide, continuing to drive innovation, continuing to bring leading edge memory technologies, and value proposition of memory is absolutely continuing to increase with the advent of AI. So it's been exciting, and that's why when you look at our new logo, I think this logo absolutely reflects the innovation and the execution engine at Micron.
Well, I want with the new logo, I'm going to be on a real effort on this, ban the word commodity when it comes to Micron. There's nothing commoditized that you do now, is there?
You know, when you look at products like high bandwidth memory, they are absolutely critical to generative AI. And it's not just about high bandwidth memory, as I mentioned. Data center SSDs, our high capacity DRAM DIMM modules, low power DRAM, all of these are absolutely driving tremendous value. Look, AI is all about applications and experiences. You need more memory to drive that experience, and that's what is driving the tremendous growth. And I think one would be mistaken if one only thinks that memory is needed for AI and data center. Certainly, smartphone and PCs and those new models have started coming out. 2025 will be first full year, increasing momentum as we go through the year. They require more content of memory. And we have discussed that in the past.
Right.
Significantly more content needed in AI-enabled smartphone and PCs as well. So from data center to the edge, memory is becoming a key enabler of AI experiences.
All right, so if I wanted to get something for high bandwidth memory from you, I wanted to order and I wanted it quickly, when would it first be available?
Well, we actually have been shipping high bandwidth memory.
But aren't you sold out if I want it?
We are absolutely sold out, but we have been shipping it. In our fiscal year 24, which ended in August, we realized several hundred millions of dollars of revenue with that product. And in fiscal year 25, we have said it will become multiple billions of dollars of revenue for us. We have the best product in the industry. This is that high bandwidth memory. This is the latest example where 12 of memory die are stacked inside. This is 32 gigabyte of DRAM memory, high bandwidth memory, absolutely critical for training, for your high-end inferencing, as well as general purpose inferencing. And Jim, I wanted to also show you a solid-state drive product. This is 30 terabyte of product.
But you got to tell people how many transistors are on that.
Oh, I mean, this is 30 terabyte means 30 trillion bytes of data in this. Of course, these are, trillions of transistors that go in these. What I want to point out is that when you look at generative AI infrastructure, you need this kind of memory, high bandwidth memory. You need storage like this 30 terabyte SSD. And this is where high performance supercomputers, they need their data from storage here. They need this high bandwidth memory, and they need a lot of low power memory as well.
Well, I think it's important to point out, I was going back with my colleague David Faber today, he was saying, well, we don't make the semiconductors. All the semiconductors are made in Taiwan. Well, it's true that many are. But tell people where you make yours.
We make our products worldwide, right? We make some of our products, particularly for the trailing edge technologies, here in Manassas, Virginia. We make our DRAM memory, of course, in Taiwan as well as in Japan. Right. We make our NAND flash memory in Singapore. So we are a worldwide company, and we are excited that with the CHIPS Act, now we are bringing leading edge memory manufacturing here to meet the growing demands, particularly for the latter part of this decade. With CHIPS Act, we have begun construction in Idaho, Boise, Idaho, for a leading edge fab to be located next to the R&D fab, time to acceleration for leading edge technologies. And then we will follow it up in New York with another cluster of leading edge fabs. Idaho first, New York later.
You haven't invited us to New York yet. What is that about? When is our groundbreaking?
Well, we are in the process of permitting approvals right now, environmental permitting approvals. Come to Boise, and we'll definitely invite you to New York as well once we get through the environmental permitting process. It's important that greenfield capacity is needed to supply the growing demand that we are talking about with AI for memory.
And it is possible people might be buying a PC in the next 18 months that might have some of this incredible technology.
Absolutely. Some of the incredible low-power DRAMs, as well as our DRAM solutions, go into PCs. When you look at AI-enabled PCs, some of the models that have been introduced, mid-range to high-end, have up to 32 to 64 gigabyte of DRAM. Low-end AI-enabled PC has 16 gigabyte of DRAM. Jim, just compare that. That compares with average of 12 gigabyte. So tremendous content growth opportunity in PCs as we go ahead with AI-enabled PCs and Windows refresh, particularly accelerating and picking up momentum in the second half of the year, next year. And same thing for smartphones. AI-enabled smartphones, last year, leading-edge smartphones had 8 gigabyte of memory in them. AI-enabled phones now 12 gigabyte and 16 gigabyte of memory.
Well, I've got to tell you, you've done a remarkable job. You've been a great steward of this company, which has really become one of the biggest and the best. And I am so thrilled you're here. Congratulations on your ringing of the bell, 15 years, and for your amazing reign, because you've done such a great job, Sanjay. Really
it's exciting time. We have guided to record revenue guidance in our FQ1, and we have said fiscal year 25 will be a record year for the company as well. Thank you, Jim.
Of course. I want people to go read the conference call if you missed it when Sanjay reported, because it's a remarkable story in the conference call of all the great things they're doing. Sanjay Mehrotra, President and CEO of Micron, symbol MU. I think it's cheap. And we're looking for bargains still, even after these all-time highs. It's Micron. Mad Money's back here for the break.
Coming up, can big bangs give you a boost? The financials reported, and Cramer breaks it down. Next.
When earnings season kicked off on Friday with the big banks, JP Morgan, Wells Fargo, something actually pretty incredible happened here. Wall Street always seems to struggle with bank earnings, which is why both stocks sold off in pre-market trading. It looked ugly, but the actual results were truly great, which is why they rebounded. With both finishing the day up big, JP Morgan jumped 4.4%, and even though it's pulled back a bit today, it's still within spitting distance of its all-time high that was set at the end of August. Wells Fargo, which we own for the Charitable Trust, gained 5.6%. and rallied some more today. It's $62 and change. It's not far from its all-time high of $66, which was set way back in 2018. I got to tell you, this is the best start to earnings season that I've seen in a long time, so let's take them one by one. Only a month ago, JP Morgan's president and COO, Daniel Pinto, spoke at an industry conference where he seemed to kind of talk down the bank's outlook, especially for the next year. He said that the net interest income, NII, estimates look too high, and the expense estimates look too low. Boy, that sent the stock down 5% in a single day. And it only recovered partially going into last Friday's earnings report. But when we finally got the numbers, you know what? They were excellent. Managed revenue was up 6% year over year, dramatically better than expected. Net interest income was up 3%, also above expectations. Non-interest revenue jumped 11%. That's another great number. At the same time, the costs were much lower, which is how J.P. Morgan earned $4.37 per share. Wall Street was only looking for $3.99. While J.P. Morgan doesn't give much in the way of guidance, it did raise its full-year net interest income forecast. It also cut its adjusted expense guidance, suggesting that the fourth quarter is looking good. Higher net interest income and lower expenses are exactly what we wanted to see. What's driving this trend? For starters, J.P. Morgan's investment banking business, it's on fire. It's up 31% year over year. Sales and trading up 8%, led by 27% uptick in their equity market revenue. I found that astounding. Second, their credit card business is doing great. It's up 11% and no credit quality issues. I mean, we're in a Fed tightening cycle, no credit quality issues. Finally, J.P. Morgan's ever-growing capital cushion and fortress-like balance sheet continue to improve. Firm also repurchased $6 billion worth of shares in the quarter, or roughly 1% of its share count. And once the banks get more clarity about capital requirements for the new banking regulations that are being finalized, they could do much more on that front. But you want to know what was my favorite part of the J.P. Morgan report? Remember those comments from Daniel Pinto about next year's net interest income that torpedoed the stock in early September? The analysts were all over management on the earnings call, hounding them for more detail about what he meant. Finally, CEO Jamie Dimon had enough and shut down the whole line of questioning by explaining how ridiculous it was to be so fixated on this one forecast, one number. The truth is, J.P. Morgan doesn't know what their net interest income will look like next year. They're very much hostage to the Federal Reserve and the bond market here. Net interest income is what the bank makes by paying you for your deposits and then lending out that money at a higher rate. It's important, but it's not the be-all and end-all. Given the J.P. Morgan situation, if the Fed cuts more slowly, that's actually good for them. But trying to predict everything the Fed will do over the next 12 months, that's a fool's errand. And he doesn't want us to get involved, and I don't want to get involved. So whether it was that feisty commentary from Dimon or just the overall strength of the quarter, J.P. Morgan stock shook off the market's initial indecisiveness and broke definitively higher. It was solidly positive by the open on Friday and never looked back. Just a great company that reported an excellent quarter and saw its stocks roar exactly the way the market is supposed to work.
House of pleasure.
So how about Wells Fargo? All right, I'll spend a little less time on this one because you know what? We got a real treat here. Do you know that we have Wells Fargo President and CEO Charlie Scharf on tomorrow night? First interview since he took over almost 5 years ago. We'll get the full download on the quarter and where the company's headed then. By the way, we already did a detailed run-through of the results for the CNBC Investing Club. I urge you to sign up, or if you're not, just please read it. But let me just say this about Wells Fargo. It was even more impressive than J.P. Morgan, at least for me. While the revenue was in line and their net interest income was down 11% year over year, non-interest income jumped 12%, well ahead of expectations, and the cost came down, which allowed Wells to post a 14-cent earnings beat off a $1.28 basis. Now, Wells Fargo, it actually walked down its full-year net interest income forecast, but they also reiterated that their net interest income will bottom this year before rebounding 2025. And that was very encouraging to hear from Wells, especially after the analysts spent so much darn time hounding J.P. Morgan about next year's numbers. It's also really encouraging to see the continued strength for fee-based income, which tells you that Wells has found success in some of its newer ventures, like investment banking, where Sharp's making a big push. This is now much more of an investment bank than anyone ever imagined. Great business, and I hope that Wells Fargo keeps winning. There is room for it to keep winning. Overall, management simply had a lot of positive things to say about the economy, with Sharp noting that, I'm going to quote, they're quote, looking for changes in consumer health, but we have not seen meaningful changes in trends when looking at delinquency statistics across our consumer credit card portfolios, end quote. Sharp also then said, quote, company balance sheets are strong, contributing to both consumption and investment in the economy, end quote. Given that banks so often trade based on how investors feel about the broader economy, these were some very encouraging comments from Wells Fargo. And that brings me to the last point I want to make about Friday's bank earnings reports. While these quarters were certainly good news for J.P. Morgan and Wells Fargo, I think they're also good omens for earnings season in the market overall. This was an incredible reminder that a whole lot of stocks can work when the Fed is our friend again. And that's what I was thinking about when I heard Jamie Dimon's annoyed comments on the myopic analysts focus on a single line, net interest income, and what might or might not happen to that next year. Rather than getting bogged down in the details, it's better to focus on the positive overall picture, which is exactly what happened on Friday. Why stress about how quickly the Fed will cut rates? Oh, God, I'm sick of that. What matters is they're giving vast swaths of the economy a big boost, and I doubt they'll stop anytime soon. Bottom line, as we move on to the rest of earnings season, let's see if the other banks can possibly keep up with JP Morgan and Wells Fargo before hearing from the rest of corporate America. All I can say is if these two big banks are any guide, this is going to be a good earnings season, thanks in large part to our new best friend, the Federal Reserve. Let's go to Bernie in Arizona. Bernie.
Hey, Jim, how you doing?
Bernie's good day. How about you?
I'm doing good. Hey, Jim, I need some help with SoFi. I have a position in SoFi. I've kept it for a long time. I actually didn't pay too much attention to it for a while. It's down now. Should I cut my losses, or should I actually invest some more now that it's lower? Booyah.
Well, look, thank you. It's up 10% today. They did this really good deal. They got $2 billion of Fortress investment to be able to originate some personal loans. Fortress is a firm that I think is absolutely tremendous. For them to be in there with these guys is extraordinary. This fintech combination, private credit lenders, is something new. And I think that I don't want you to buy. Look, we don't buy things up 10% in a single day. But wow, this is a brand new SoFi as far as I'm concerned. Let's go to Trey in Texas. Trey.
Jim, I love the stock market. 3 years ago, I was in a small studio apartment, and now I live in $1 million home with no mortgage.
That's what I want to hear, man.
Absolutely. So just after my parents bought me the house, I opened a Robinhood account and started trading with the money I previously spent on rent. And with rates falling, I jumped into Upstart last week, and I'm up a clean 30% already. Jim, do I take the easy dub here or wait and retire early with this one?
Okay, here's what I want you to do. I want you to do it right now, Trey. I want you to sell it and pay back your parents. Because I've heard everything. I thought for sure I was about to hear about NVIDIA and what NVIDIA's done for you and Amazon. No, it's your folks, okay? Now, I love that. And I think it's great that you gave them a shout out. But let's do this. Let's sell some of the Upstart, absolutely. And let's just, I don't know, throw them a bone. All right. If JP Morgan and Wells Fargo are any guide, I say this is going to be a strong earnings season, thanks in large part to the now friendly Federal Reserve. Can you believe we have Wells Fargo on tomorrow? Come on. When you heard that, weren't you excited? All right, much more Mad Money Ed. Excited about sitting down at Wells Fargo. Yes! Okay, including my exclusive with Adobe, fresh off a host of new product announcements. I'm hearing what the future of AI and the Creative Cloud looks like when I discuss it with Shantanu and Ryan. I got to tell you, the stuff that they have is just breakout. Then everyone wants to buy the underdog, so I'm revealing what cohorts I think have potential runways ahead of them. And, of course, all your calls rapid fire in tonight's edition of the Lightning Round. Why did my parents never give me anything other than a lot of grief because I wanted to stay at home and watch Phillies? Stay with Cramer. A month ago, when Adobe reported what I thought was a good quarter, the digital media and marketing software play, well, it saw its stock get pulverized because the guidance was a little light, but that was enough for Wall Street to totally turn on this one. That's wrong. At the time, I told you that Adobe was worth buying on weakness, and that's pretty much what you've gotten. That is until today, when Adobe kicked off its Max conference in Miami Beach, where it introduced a barrage of new features, very exciting stuff, including AI-powered software tools for marketing. In response, the stock shot up nearly 3%. So is Adobe finally getting the credit it deserves? Let's take a close look with Shantanu Ryan. He's the chairman and CEO of Adobe. Learn more. Mr. Ryan, welcome back to Mad Money.
Thanks for having me, Jim. Always great to be on your show.
Oh, I love you on our show. And I got to tell you, Shantanu, we were playing around with everything we saw today. We realized for designers, it's great. For people who don't necessarily have the inclination about how to design, it's great. But I want to know, how much money can Adobe shareholders make if everything pays off with AI?
Well, as you say, Jim, it first starts with innovation, and we are innovating like no other large company in terms of making sure that we infuse all of our products with AI. We're innovating across 3 layers of the AI stack. We introduced our own video model today. We certainly have imaging and vector and design already in the case, as well as Acrobat with AI Assistant. And on the interface layer, what we're doing with embedding it in Photoshop or Premiere or Illustrator or Adobe Express, we've said that we've had over 13 billion generations, and that's actually accelerating in terms of the usage. We monetize it 4 different ways, Jim, to answer your question. The first is as part of our subscription tiers for both Creative Cloud as well as Document Cloud. it's embedded, and we want people to use it. This is all about adoption of these new features for creative professionals. We have add-on offerings, Acrobat AI Assistant, as well as what we are doing with video, because video is more compute intensive. So we've said that, we expect to monetize that differently. On the digital marketing side, you talked about the fact we are the largest provider of marketing technology in the world, and we have these tiers. We have tiers which are called the ultimate tiers and prime tiers, which embed all of our AI stuff. And perhaps most exciting, we have these brand new services, new products like Gen Studio, as well as what we are doing with Firefly services, where people can create custom models. So CNBC can create a custom model just for yourself. Retailers can do that. Banks can do that. So, across the spectrum, we're both innovating as well as monetizing.
We were playing with it today, and, my daughter's a user from Parsons. We all just kind of feel like, we can design ad campaigns that we thought were $30, $40, $50 million, that we can design them in an hour for just the cost of subscription. Now, maybe we're dreamers, Shantanu, but when we were playing with it, it does seem like it's possible.
I think what we've done with Gen Studio for performance marketing, to your point, Jim, is truly revolutionary. We now have in one product the ability to say, what's my brief for the campaign? Who am I trying to target in terms of the audience? How do I create a few hero assets which allow you to specify what the campaign is doing? And then the system can take over. It can create thousands of variations using AI. It can automatically put those ads. We announced integration and partnership with advertising networks like Meta and Snap and TikTok and Google and Microsoft. And then as that performance improves, it's a virtuous cycle because we place more ads there. And conversely, if an ad is not working, you can reduce it. And so this is all provision for the user to just come online and say, I would like to try it and create my campaign. So, we think this is just the beginning of bringing the creative and marketing worlds together. And to your point, solopreneurs, people who are focused on businesses or restaurants or commerce, now the fact that they can, with Adobe Express, create a menu or create a website or create a mobile application and acquire customers. I mean, how cool is that?
Oh, we thought it was really great. It really is the way for someone who has one restaurant to have 4 restaurants. You got to be able to scale, but we don't know how to scale. You scale with you. Now, another thing that we were playing around with that I thought was very exciting was the Gatorade bottle. I mean, come on, we get to think and we get to make stuff that's really cool. Younger people, older people. Tell us about this campaign, because I thought it was electric.
Well, what's happening, Jim, is that every single person wants to deliver a personalized experience, right? Whether you're buying a shoe, whether you're buying a water bottle, as you say, with Gatorade, whether you're trying to create a new campaign. So the new word that's clearly taken off is personalization at scale. What Adobe pioneered with Adobe Experience Platform was the ability to know every single one of your customers. And now we're augmenting that with being able to create all of this personalized content at scale. And so, the Gatorade bottle is your way to say, how can I create it? How can I change the colors? How can I make it just truly for myself? And I think it's just the beginning.
Now, I wanted to ask you about the notion of the designer. I've always felt that a designer should go to Adobe to get the best designs. But now I'm wondering how do you reconcile, you can get people to become designers who aren't designers. Are you kind of internally, is there a division where you don't want your designer to be angry at the person who does know how to design, but we want everyone to be creative? So how do you break it down between the person who's becoming a designer and the designer who's probably worried about whether someone's going to take that job?
Well, every, tectonic shift in technology actually is potentially disruptive. But we are more excited, honestly, by our ability to democratize access to this to way more people. The number of people who have an idea in their heads and quickly want to, whether it's on a mobile device, whether it's on a PC, across every media type, make that available is just, massive. And a lot of them also don't want to do the rote automated tasks that everybody asks them to do. So I think this is a win for designers. I think it puts more creative tools in their chest, but it also allows them to collaborate with their customers. And so this is about bringing concepting, creation, as well as collaboration together. And I think ultimately there's more content that's going to be created. There's more commerce that's going to happen online. every customer wants an individual personalized experience. So I think it's a win-win. And last thing I would say is that humans who use AI are going to potentially replace humans who don't use AI. And so this is all about augmenting human creativity.
How fast is all this happening, Shantanu? Since we first talked about Firefly, now we're doing video. We're getting bounds for video. We'll be able to use for video. In the next few weeks, people are going to be doing video ads that never have dreamed. How fast is this technology improving the speed of things?
It is truly mind-boggling. And I think it's mind-boggling because the entire industry is, focused on this. When you think about what companies in the chip space and what, Jensen at NVIDIA and the others are doing, certainly Qualcomm in order to make that hybrid, Lisa at AMD. So I think the infrastructure has become dramatically better. Then you think about the hyperscalers and what they're doing about getting these services available in APIs that's quick, to access. So I think the magic is really taking all of that stuff and making it controllable. So, it's in the workflows, it's in the applications that we use where the real magic is happening. But it's, I've been through the internet revolution, the mobile revolution. This one seems way faster and it's hard to predict. But, I think at Adobe, all we are doing is to say, how do you unleash all of the magic that the creative product teams do? And sit back and enjoy it.
Well, you're doing it. You're doing it. I wish I were down there with you because it's just so exciting. That's Shantanu Narayan, Adobe Chair and CEO. Hey, go check the Gatorade thing. I'm not kidding. We were all designing our own bottles. It's so exciting. Thank you, Shantanu. Great to have you.
Always great to be on your show, Jim. Thanks for having me.
Everybody's back in for the break. And then the lightning round is over. Are you ready, Ski? Daddy, time for the lightning round. Let's start with Michael and Merrill. Michael.
Hey, Jim. A Baltimore booyah to ya. Go Ravens.
Hey, Raven booyah. You're looking real good. I like that team very much. How can I help?
With the escalating electricity demands driven by AI data centers, I would like your opinion on an energy stock that has really rallied on a year-to-date basis. Is there more room to run on Vistra Energy Corp, stock ticker VST?
Okay, this is a very complicated situation because what I said the other day was you got to let it come in. It went down for a couple days, and then it's right back up. Let's just say this. Own it. Put a half position on. No more. Put a half position on, and then let it come down because it has had such an amazing rally. I can't just say go buy it. Let's go to William and Maryland. William.
Hey, Jim. How are you doing? It's so glad to hear you. Hey, I had bought some NVIO Nordis earlier in the year, and it's taking a real roller coaster. So I'd like you to comment on that. And also, a while ago, you had said that to watch when the patents end on those farmers. How far in advance should you, be ready to trade on those?
You don't have to worry about that. Usually it's about 4 years before people really start thinking about it. That's what we have with Merck and some of the others. Now, look, I've got to tell you, Novo Nordisk doesn't hold a candle to Eli Lilly. Eli Lilly will be on for the Travel Trust. I'm going to be talking about it at Wednesday club meeting. It's a really important meeting. Sign up for the club. You can be in. It's an hour-long broadcast. I think you'll get a kick out of it. Lily's the one. Alan in Florida. Alan.
Jimmy Chill.
Yo.
Big thanks for your Investors Club. It's proven to be more valuable than my much more expensive MBA studies.
Well, there you go. Wow, that's it.
Jimmy,
whoa, really?
I need you to listen to me. This is important.
Listen. I'm totally focused.
Nuclear energy has gone from dirty word to darlings of countries going green. Big tech desperately needs nuclear for their AI data centers. The world's largest banks are on board to support the nuclear build-out. Diablo Canyon, Palisades, 3 Mile Islands, they're all restarting. They all need uranium. Bill Gates' TerraPower, Sam Altman's Alco, all need uranium. Google just announced today an SMR nuclear deal. Long-term uranium demand is soaring while there's already a supply deficit. Insiders have been buying, and production has started at the stock you gave us in the threes. UEC, they are...
UEC's the real deal. You got to double, it doesn't matter. It's going higher. We need more uranium. I think it's a great situation. I recommend it to all my friends. Just like the books at the library when you were in third grade. I think it's terrific. Let's go to Corey in North Carolina. Corey,
Jim, man.
Yeah, you're Corey. I'm Jim.
I've been watching Mad Money for about 2 months now, and I'm hooked. You and your team are fantastic.
The team is what makes it.
It is a team, and you guys do it very well. Thank you. Looking for some information on Halliburton, HAL.
No, I don't want to own. Look, I'll tell you, if the oils couldn't go up during the Mideast tension, they're not going up. I want to stay away from Halliburton. That's too bad. It's a really great company. And that, ladies and gentlemen, conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, everyone loves an underdog. Cramer sees two in the biotech space. Revealed next.
People always want to buy underdogs. Do you remember this summer when we heard it was time to buy the small caps? Then they're down so low they were ready for bounce, a serious bounce, make up for lost time. It worked for a couple days, didn't it? But almost as soon as the group was anointed as the next big thing, well, the stocks stopped going higher. Or take Boeing. I can't believe there are analysts still recommending this thing, which is seemingly on the ropes given that machinist strike, 17,000 person layoff from Friday night. Yet even though Boeing needs to do a huge equity offering to raise some cash, there are a bunch of analysts saying this is the time, right here, right now. I can't see how you justify owning this one. Boeing's been an endless disaster, but that means nothing to these bulls. If you want an investable underdog, though, I think it's the banks. Now, we haven't seen a true bank rally in ages and ages, the kind of rallies we used to get in the 80s and 90s. This group is so far behind the rest of the market. I got to tell you that when Wells Fargo reported a good quarter last Friday, as I mentioned earlier in the show, the stock roared. I'm hoping this is the beginning of a bank stock renaissance. And as I said earlier, Wells, which is on tomorrow night on our show, could be the leader. So you need to understand, even though the banks bounced back from the financial crisis, they've never really been the same. During the Great Recession, the big banks became wards of the state. They had to offer a huge number of shares. Many had to cancel their dividends. Obviously, the industry brought this on itself. But since the financial crisis, they've been regulated like no other group. They've been bullied repeatedly by the Federal Reserve overlords. They've repeatedly embarrassed by a whole new entity. It's called the Consumer Financial Protection Bureau. There's a supervisory cycle that includes the equivalent of public floggings. The gauntlet's just too hard for most investors to get through until now. The banks are going to start being regulated. Yeah, well, they'll still be a bit hard. They got federal charters. They got federal insurance. Many banking crisis was just a year and a half ago. But as I see it, something changed on Friday. When one time near to Wells Fargo put up those good numbers, and the stock actually went up. I think this might be kicking off the first great bull market in the banks in 16 years. Why? Simple. It's because the banks got too cheap relative to the rest of the market. The S&P now sells at 21 times earnings. Yet there remain so many bank stocks that sell between 13 and 14 times earnings with good yields. That's enough of a discount to compensate for the heavy regulation. Look, at Wells Fargo, which sells for just, look at it, 11 times next year's earnings. Real haircut because 6 years ago it was sanctioned by the Fed. That sanction included an asset cap, which is a severe restriction. Under its old management, Wells was a real bad actor. So they arguably had it coming. But they got a whole new CEO, Charlie Sharp, pristine reputation from his time at Visa and JP Morgan. He's replaced most of the board of directors at this point, along with the whole senior management team. Didn't win him any lenience from the Fed, though. Now, though, I think the banks are finally de-risked, if only because the rest of the market has run so much. So if you need to own a cheap stock, look no further than the financials or some others. If you want some more underdogs, how about the drug stocks, the big ones? Right now, the activists at Starboard are trying to challenge the leadership at Pfizer, a good company with a 5.78% yield and the prospect of a revolutionary approach to treating cancer. If the new cancer platform pays off, you have a very, very big stock. In the meantime, the stock trades at 10 times next year's earnings estimates, and Pfizer's paying you to wait until with that bountiful yield. J&J's been held back by baby powder litigation for years. But I think that number is finally about, I think it's ending. And when it does, the stock could snap right back because the actual business is doing pretty good. Merck's doing a phenomenal job at developing new drugs via acquisitions, and it has the premier cancer drug, Keytruda. Okay, it goes off patent in 2028. Still, there is so much in the pipe here that I think it's worth paying 11 times next year's earnings for the stock. In the end, we've had a terrific 2-year run, but there are still many stocks out there that are inexpensive. You just need to know where to look for them. Like I said, as always, bull market summer. I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and/or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.